This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, I'll be doing a portfolio update for the month of May 2022 on my Sharesies public portfolio. So in this month's update, I'll be sharing with you some of the transactions that I've made and the reasons why I made them, because there's been quite a few companies within the portfolio that have reported their results. So we'll be talking about those as well. And today's video sponsors are Easy Crypto. If you haven't already used Easy Crypto, they are by far the easiest and safest way to buy crypto in New Zealand. Use the link down below for $10 off your first purchase. As well as that, it is now past 31st of March 2022. And if you live in New Zealand, you probably should be filing your taxes soon if you haven't already. Personally, I like to use Sharesight to track how much taxes I need to pay on my share investing. So for example, with dividends and fifth taxes, Sharesight makes it very easy to calculate those taxes. I have a link down below. If you do decide to sign up with Sharesight for a 12-month plan, you will get 4 months for free using the link down below. And with no time wasted, let's get right into the video. So over here is the Sharesies public portfolio. As you can see, the portfolio value is $21,973.25. This amount does not include the $1,676 of cash in the wallet ready to invest. Simple return is 6.71%. And you can see the portfolio returns have gone down significantly again in May. So if you are feeling the pinch on your portfolio, you're not alone. I am here with you, suffering together. That is the way to go. If you need counseling or if you need someone to talk to, leave me a comment down below. But anyways, here are the portfolio positions. You can see here Auckland International Airport, Collins Foods Limited, Heartland Group Holdings, Infratil, Macquarie Group Limited, Oceania Healthcare Centre Group, and a new addition to the portfolio compared to last month, and that's Summerset Group Holdings. This stock doesn't need any introduction because this is a stock that I previously have had in the portfolio, and I've covered this stock a long time ago. I'm pretty sure you can find a video over here about Summerset and how it makes its money. Very similar business model to Oceania Healthcare. However, I think Summerset is better suited for growth going forward. Now, I'll talk a little bit about that later on. But now I want to show you the Sharesight tracker that I use to track my portfolio performance. So you can see over here, I have the Sharesies public portfolio performance. In the past month, the portfolio has delivered a loss of 3.49% compared to the FNZ ETF. That ETF has delivered a loss of 3.96%. So overall, the portfolio has outperformed by about 0.5%. And over here, you can see all the positions in the portfolio are in the red, except for one, which was Oceania Healthcare. Oceania Healthcare has been a serial underperformer for the portfolio. Oceania Healthcare did report their full year results towards the end of May, and I have made a video covering that. You can check that out over here. But to give you a very quick summary, basically the results showed that Oceania Healthcare was pivoting from their care premiumization strategy into their independent living unit strategy, basically highlighting that care is facing a significant amount of headwind and it doesn't deliver a sufficient return relative to what they could find potentially in the independent living unit space. So what this does show is that, the Summerset model basically is more attractive than the Oceania model, the care model. The independent living unit model right now at least is more attractive to the care model. And so that actually did highlight some of the concerns that I had with the company, whether they had sufficient pricing power in their care model to increase their prices to outpace inflation. As we've seen in their results, the margin hasn't been increasing. Care margins sit at around 12-11% compared to where they were 4 years ago when they IPO'd at around 18-19%. So there's a significant drop in care margins, and it does show that reliance on the government to increase their subsidy for aged care is not really a good business because you're reliant on the government to provide you with your profits. Where the company will succeed though is where they build units and sell them at a profit because they're able to control that much easier than what they would receive from the government, for example. So I think this is a good pivot, And over time, I am pivoting my holding in Oceania Healthcare towards Summerset as well. Now, I did mention that I would wait for a more attractive price to sell Oceania Healthcare, given that $1.05 is well below intrinsic value in my opinion. However, I do see Summerset as being good value here as well, given that Summerset has also dropped very significantly as well. In terms of all the trades that I've made in the month of May, you can see that I've been selling down Oceania Healthcare. You can see that I've sold about 500 shares. As I mentioned, I am waiting for a more attractive exit price. As the share price goes up, hopefully I'll be able to offload some of my shares of Oceania Healthcare and move them into Summerset, for example. So for the month of May, I did buy about $1,000 worth of Summerset. This was a position that I have previously held in the portfolio, and it was a bad move on my part to sell Summerset, although you could argue that I didn't really make any loss, because you can see that I sold Summerset in October 2020, and the share price back then was about $10.45 per share. And right now, I did recently buy them back for about a similar price, slightly higher. But the opportunity cost here is that I had to pay that transaction fees. I had to forego the dividends that I would have received from Summerset. And the reason why I sold Summerset was to buy Oceania Healthcare, which I later on made a significant loss on it, actually. You can see Oceania Healthcare is one of the largest loss positions in the portfolio. It is the largest loss position now, actually, after selling out of Kogan. I'm not selling just because I lost money in Oceania Healthcare. I am selling because my fundamental thesis in the company has changed. So now let's talk about some of the other moves that I've made in the portfolio as well. You can see over here that I did sell half of my Heartland Group position. I sold 800 shares, and that was a net proceeds of $1,676. Now, the reason why I did sell Heartland Group holdings was because Heartland Group will likely have a very high correlation to the strength of the economy in New Zealand. I think the economy is going down. The reason why I think that is because we do really have a cost of living crisis in New Zealand. I see petrol prices increasing significantly, mortgage rates particularly increasing, which is very scary because there was a graph by the RBNZ showing that the percentage of disposable income by first home owners that recently bought a property on an 80% LVR has increased from about a low of about 30 to 35% to now all the way up to 60%, somewhere around there. So basically, the cost of a mortgage has doubled in terms of a proportion of your disposable income. And I think this is really risky. I think this will have a significant impact on household spending. And when households don't spend as much, that will flow on to a potential recession. As well as that, Heartland Group has a significant exposure to the reverse mortgage market, and usually reverse mortgages do well when house prices are increasing. But when you have a situation where house prices are no longer increasing and might be decreasing now, as well as interest rates going up, you have a double whammy, and I think that could potentially impact Heartland Group's reverse mortgage business. Heartland Group also owns a significant shareholding in Harmoney Corporation Limited, which is a New Zealand company providing personal loans to basically people that can't get a loan from the bank. These are loans that are usually at a much higher rate than what you would get from a bank. The share price for Harmoney has gone down about 37% since the end of last year. So in the past 6 months, or on the past 5 months, I should say, the share price is down about 37%. So what that means is that for Heartland Group that has 10 million shares in Harmoney, that would equate to about a 7.4% loss on their investment. Although this is an unrealized loss on investment, I think this will have an impact on their full year results this year. So because of all these factors, I decided to trim my position by half. So currently I have 800 shares in Heartland Group holdings left after selling off about 800 shares. So I've used some of that proceeds to add to my position in Macquarie Group Limited, which is a much larger bank, and you can say that this is a more diversified, safer play in the current economic climate. You can see that Macquarie has dipped quite significantly in the past month by 7%. On the 6th of May, you can see that the share price dipped 7.78%, and this was a result of them announcing their full year results. Now, if I show you the results, you might not actually believe me that it dropped by 7.78% because in their results they highlighted that net profit for FY 2022 of $4.7 billion was an increase of 56% on FY21. So net profits increased by 56%, but the share price dipped 7.78%. So the reason why that is the case usually means that expectations of investors were much higher than what the company delivered. So the reason why they made such a huge profit came from two sources. Firstly, came from their Macquarie Capital division, whereby they had investment-related income increasing substantially due to material assets realizations in the green energy, technology, and business services sectors, and an increase in the private credit portfolio. So they realized some assets, made some significant one-off gains. Another source of this outsized increase in their profits was related to the commodities and global markets. They had increased revenues across commodities with strong risk management from gas and power businesses, resources, agriculture, and global oil, driven by increased client hedging activity and trading activity as a result of elevated volatility and commodity price movements. So as you know, oil prices have been going wild. Commodity prices as well have been going wild as a result of the war in Ukraine. Because Macquarie Group has a division that facilitates, delivery of commodities as well as providing financial instruments for clients to hedge against the price movements of these assets, Macquarie Group actually benefited significantly from the volatility in the market. And because of that, we see the market-facing activities, which is the combination of both Macquarie Capital and commodities and global markets, increased by 92% on FY21. This is a huge increase in profit, and Macquarie themselves have said that you shouldn't expect this type of growth going forward, and I think that's reasonable, but to sell off 7% on the day of announcing this spectacular result to me seemed a little off, and as a result I did manage to buy some shares at a lower price. I bought some at $186.50, although I could have waited a few more days and bought it at a lower price at maybe $175. However, the share price is back to where it was basically, as well as that they announced a $3.50 dividend on the stock. So I managed to capture some of those gains over here. So we will be receiving a $22 dividend on this position. Not much, but that's something, and that adds to the dividends overall that the portfolio has received, which you can actually click on total return and see how much dividends that you've received overall. So this portfolio has received about $728 of dividends, almost half of the total returns in the portfolio. So this portfolio is a dividend portfolio, and over time I am expecting dividends to increase as the portfolio size increase, and this should serve me well in a time of recession or in a time where stocks fall, because dividends can be reinvested at lower stock prices. So that's the thesis behind a dividend paying portfolio, which is very much what I'm trying to do here. Now, going back to Macquarie, you can see that the analysts are forecasting lower earnings per share in FY23. So they delivered $12.31 this year, but next year analysts are expecting on average that the company delivers $10.64 per share. So if you take that divided by the current share price, the PE ratio is about 17.5 times earnings, which in my opinion is pretty reasonable considering Macquarie Group has a very strong track record of growth. They have a diversified business model where if there is volatility in the market, the CGM division will do well. If there's not as much volatility, they'll grow from other sources like asset management as well as banking and financial services. If interest rates rise, they can increase their interest income from banking and financial services. There's basically a lot of moving parts in Macquarie. I think it's a very well diversified business model, and it's much safer in my opinion compared to a smaller banking operator like Heartland Group Holdings. And with Macquarie Group, you are not just buying a retail bank, you're also buying an investment bank, an asset manager, as well as a commodities dealer. So in my opinion, Macquarie Group makes a lot of sense, which is why I have recently trimmed my position in Heartland Group and topped up my position in Macquarie. I do want to highlight as well the CEO of Macquarie Group. She owns 1 million shares in Macquarie at a share price of $185. That's about 185 million Aussie dollars worth of shares. So I think the incentives there are very well aligned, and I think management will execute well going forward. So that's all for today's video. Hopefully you enjoyed it. Let me know in the comment section down below as well what stocks you're looking at. I'll be very interested to hear what you guys have to say. So thank you guys for watching. Until next time, take care.